inherently, it's not. So they've resisted and suppressed the market. They first, and the smaller market that they could hold down was the silver market. They're doing that. Now we've run out of delivery space. They have to let the silver price do some price discovery. But what you do is, if you keep the resources down, you keep the interest, because America is stock traders. They're into their property values, and even more, they're stock trading nation. So you don't want it, and they could actually keep structural shorts, various other things on individuals. In fact, First Majestic had a very high short number at one point on them, known short number. And it's intentionally ignore giving excess coverage. How many times do you turn on CNBC? I don't turn them on at all, really, but occasionally I look just to see what the lie is of the moment, and you actually see them talking about Heckler or First Majestic and the incredible reports. I did notice that. So there's two potential outcomes for why that might be. One, people who buy stocks are a different group of people than industrialists that need silver. So where's the demand coming that's driving the silver price? This is not a retail silver squeeze the bankers thing. Retail is a small component of this, and they've done margin increases. And by the way, key point on that, margin increases have put more pressure, upward pressure on the price, not downward. And I'll explain that in a bit if you want me to drill further on it. But anyway, let's park that for now. So this is a producer, a desperate producer-driven, physical demand-based bull market. It's not a, hey, all the libertarian free us from the Fed guys are using leverage to squeeze the banks. The effect is the same, but it's not being driven by us. It's not being driven by anything apart from people don't consider themselves to own silver truly unless they've had it delivered and it's under their control. And there is a loss of confidence in the system. This is a confidence-based crisis and trust in the system. The fiat and the debt is debasement, one of the same, fiat and debt. They're not separate assets. One is fiat later and one is fiat today. And we're in a debasement cycle. And when I draw these silvers in that parabola, the debt debasement is in this parabola, and you end up, when you add the two lines, with gold that holds value.
At its core, this silver move reflects something deeper than supply and demand. It is a loss of confidence in financial systems built on debt and fiat currency. Fiat today and fiat tomorrow, via debt, are effectively the same promise, just deferred. Both are being debased. In this environment, precious metals act as the counterbalance. Gold preserves value. Silver challenges the system directly. Unlike gold, silver is consumed and removed from circulation. That makes it uniquely disruptive. As trust erodes, ownership shifts from paper claims to physical possession, turning silver into a referendum on financial credibility.
You add them two together. So the one parabola that is inverted is causing the other parabola that is normally ascendant. And that's where we are. And silver is the anti-fiat. We've used and coined the phrase. I don't. One or two people copied us once or twice, but I don't see it gaining any traction. But it's the best way of saying it. There's a fiat and there's an anti-fiat. People can do it with religion and have a Christ and an antichrist. I don't see why they can't do it. And I see it very much in the same spiritual kind of war, if you'll excuse the analogies and the topic drift into all sorts of other areas. But the anti-fiat are precious metals. Gold is the king anti-fiat, silver is the queen, but the queen actually gets consumed and has a physical delivery issue. Gold can be recycled, and there's a lot of it stored in bullion. So we're getting a turbo on top of a turbo. Gold is the turbo and the king of the turbo. Silver is the twin turbo because it's got the production shortage to the consumption. And every new tech that they want us in that is battery driven, all the reasons for making it more efficient, like the solid state battery, if you were to get a solid state battery, those do 900 Ks range for a car, by the way. If 20% of that take up was in that solid state battery, why would you want the old battery? which the solid state charges in 8 minutes, or gets to at least 80% charge, I think it is, in 8 minutes. That's as long as you normally take to fill gas on an ICE engine. I don't like battery, and I won't be doing it. I'll resist as long as I can, but that's a moot point. The health benefits and all the other stuff. But they want everyone in a battery car so they can remotely control you and call you in and track and trace you like they do with their phone. And that's going to take off. People are going to want 900K range.
Modern technology has quietly transformed silver into a strategic material. Electrification, renewable energy, advanced batteries, and high-efficiency electronics all require silver, and often more of it per unit. Next-generation battery technologies, including solid-state designs, promise faster charging and longer range, but at the cost of increased silver intensity. Unlike gold, silver cannot simply be recycled at scale without losses. Every technological upgrade accelerates depletion. This creates a compounding effect. Rising demand meets shrinking availability. The result is structural scarcity, not a temporary imbalance, and that scarcity is now colliding with financial instability.
And they're going to want less of a depreciation cycle. Think the Porsche Taycan, very nicely finished, but you've got a 55,000 pound battery change after 4 years because the range each year reduces on use. So, there's so many drivers, silver's going to run. Your question was, why miners not so much yet? Because retail is wrecked in terms of investment. We're in a stagflationary environment. We're going to roll into a hyper-stag, the extremer version of it. You've been in a sustained recession in and out if it was truly covered with real statistics, not the fake employment and the fake inflation numbers that we're beginning. You've been told that, consumption was good. Well, that's in increased expenditure. Well, that's on the fact that the dollar buys you much less. If your grocery shopping cost you 5 years ago, $350 for you and your girlfriend, and it now costs you $600, you are spending more. GDP has gone up. Well, that's a bad measure if you're not adjusting it fully for the inflationary effect. So we've said the grand lie of inflation. So your retail investor is wrecked. That's who's not being able to get in there on any grand scale. Then you have to think about the big guys and the institutions. Banks don't want to vote for Christmas. Turkeys don't vote for Christmas. The last thing they want to do is start buying silver until they've first covered all their shorts and got out. So they're trying to do that. That's what's happening. There's rumors about UBS. I'm sure you heard them as well. And the SMB saying you need to close out. And I don't think they can feasibly do it. But anyway, so institutions and banks and ETFs, where everybody's saving money. Everybody got crowded out of making their own decisions long time ago.
Retail investors are largely absent from this rally, not by choice but by circumstance. Years of inflation have hollowed out purchasing power, even as headline statistics mask the damage. Higher spending does not equal higher prosperity when currency buys less. In real terms, many households are poorer. Meanwhile, institutions are trapped. Banks remain heavily exposed through legacy positions and cannot easily reverse course. ETFs have funneled capital into the same overcrowded mega-cap stocks, leaving real assets ignored. Silver is rising without public participation, historically the most explosive phase of any commodity cycle.
And bought ETFs. And because of technology being what it is, the technology ETFs were it. So everybody's historically got all their performance from Mag 7. And in fact, the indices often haven't gone up if you take out Mag 7. So what we actually have is a crowded out trade brought by computer buying because it's cheap and overweighting into ever grander stocks. So we have mega trillion, 5 trillion market cap, individual stocks that are hopelessly overvalued. And we have silver miners that are grossly undervalued because everyone else is lazy and wants cheap entrance into the market and thinks what performed for the previous decade and the previous decade before that is going to continue to perform. And our point on 2020, why I said it's the most important call we ever made, is that the thing turned. Debt and fiat started to collapse. And in fact, the NASDAQ is not performing divided by gold, the only accepted true unit of account when you are in fast devaluing, I think always, but specifically and especially when you're in a fast devaluing fiat and debt debasement time. I was just looking at the US, the Japanese 2-year and the 10-year. They are parabolas up in the interest rates, which means the valuations are parabolas down. and they are a slave nation that will be buried with the pharaoh king, the dollar, as is, I suspect, Korea as well. So we're looking at these fundamentals and saying, divided by a gold ounce, actually there's very few things going up, except silver miners, despite not really responding recently. They did well over 125% last year, some 130. So there were big movers in that. But is it in the interest of the cartel to normalize investment into silver mining? They don't want you to be rich. They want you in a Mag 7 paying for the surveillance state. When you buy and increase the market cap of the surveillance state equities, such as Facebook, Microsoft, etc., you give them cheap equity for which they can consume any rival products, anything else. You give them massive leverage, massive power, and of course, BlackRock controls them because everybody's used an ETF. That's what they want.
Today's markets reward size, not value. Capital flows automatically into the largest stocks through passive investing and algorithms, reinforcing dominance regardless of fundamentals. Smaller sectors like silver mining suffer from neglect, not weakness. Liquidity attracts more liquidity, while undervalued assets remain invisible. This self-reinforcing loop has inflated technology valuations while suppressing resource equities. Yet regimes change. When monetary systems destabilize, valuation anchors shift. Mining companies don't need hype, they need earnings. As margins expand and cash flows surge, attention will follow. Markets eventually price reality, even if they resist it at first.
They don't want mining companies and resource companies becoming the new bull market. They want the cheap currency that helps them build out the surveillance state that they want to drop over you, the grid, the prison grid that is coming. So if you think about it, the system is not geared. Thirdly, the liquidity, because it's a self-fulfilling prophecy as well. Rather than being something, if you're at the extremes, you automatically get withdrawn back to the mean. Some models, if you're at the mean, you get pushed past to the extremes. Once you've created such liquidity availability on the Mag 7, and you have this huge hoard of money going into the ETF, you can't plug it into these tiny cap silver miners, even the biggest of them. You'll absolutely moon them, and you'll have a massive pump. You would have to add slowly, incremental additional flows of capital until the market cap has grown, the tradability has grown, so that you could continue to pour more. There's almost a function of size begets more size. That's what I'm talking about, going to the extreme. And if you're on the small side and you lose interest, you aren't covered by analysts, you get less interest, less people trade it, less liquidity. You can't buy out other companies. No one wants your stock. It doesn't go up enough. You fall off the radar, and eventually you become a nothing penny stock with a few people that might know what your business is about. So that's the polarity from the mean towards the extremes. Mag 7 was on the positive side and has been fostered positively. Resource and mining is that old hat. What's that all about? The epoch changed in 2020, and this is how long it takes for people to realize, and they still haven't realized it yet. More 120 plus, 130 plus years, then you'll be ready for 300% year. That's how I see it happening, and that's why we're still early in this, and that's why there'll be catch up. And watch the earnings seasons when the miners start delivering unbelievable numbers. And I hope they're on hedging, because I'll come back to that point later if you want to dig deeper on why margin reductions are actually pumping silver, not reducing it. But that's my answer. It's the industry got old schooled. It got dulled, and it lost capital flows, and you need size to build more size.
The shift began years ago, but recognition lags reality. Debt saturation, currency debasement, and declining trust marked a turning point that many still refuse to acknowledge. Silver miners have already delivered strong gains, yet valuations remain historically compressed. Suppression narratives fade when numbers overwhelm perception. As production shortages intensify and profits expand, resistance breaks down. ESG constraints and underinvestment have only amplified the setup. This is not the end of the move, it is the foundation. When capital finally rotates, it will not be gradual. It will be violent, overdue, and impossible to ignore.
That was me. That was my conspiracy theory. I don't have facts for, but that's me spitballing. Inherently, It's not. So they've resisted and suppressed the market. They first, and the smaller market that they could hold down was the silver market. They're doing that. Now we've run out of delivery space. They have to let the silver price do some price discovery. But what you do is, if you keep the resources down, you keep the interest, because America is stock traders. They're into their property values, and even more, they're stock trading nation. So you don't want it, and they could actually keep structural shorts, various other things on individuals. In fact, First Majestic had a very high short number at one point on them. Known short number, and it's intentionally ignore giving excess coverage. How many times do you turn on CNBC? I don't turn them on at all, really, but occasionally I look just to see what the lie is of the moment, and you actually see them talking about Heckler or First Majestic and the incredible reports. Have you seen Keith Neumeyer on Business Night? No, they bring you Zuckerberg, Nvidia. You get him 20 times in a year. At every conference and everything, and Gates and all of that. They've created who's cool. This is Hollywood. They choose the actors they're going to promote and who they pay, and they actually want to keep the ones that do damage to their cause out, that speak too much truth. And that's a club. And, the silver miners aren't in that club. But eventually, just like for silver and the suppression game, numbers talk and BS walks, and they're going to be turned into cash cows, hemorrhaging cash cows, and the less they hedge, in fact, the more the price is going to go up and the more profit they're going to make, and eventually you're going to have something that's going to be on such ridiculously low PEs that they're going to start running, and that point that will come, like everything, but everything takes time, and I think they've actively resisted adding coverage to the industry as a whole and the miners, and I think the ESG part of that, the ESG part prior to this collapse, very much worked to help take the knees out of mining and resources company. We were meant to see them as dirty old businesses, and they did a lot of damage, and that's going to be wound back.